Hey everyone, and welcome back to another 4 stocks to buy or put on your watch list in a certain month, in this case in the month of October, the 10th month of the year. Yes, to be honest, the year flew by. Now it's been a pretty good year for the stock market as a whole, right? S&P 500 is up 20%, Nasdaq up close to 19%, Dow Jones up 12.27%, and the Russell 2000 up 10.74%. Now, the Russell 2000 actually quarter to date, as you can see, has outperformed the other ones. Of course, small caps do better in lower interest rate environment. With the anticipation of a rate cut plus the announcement of a rate cut, we've seen this outperform the others. Now, in this video, I'm not going to talk about the usual suspects, right? The Alibabas, the PayPal, the SoFi. They could be on the list. Alphabet could still be on the list as well. Plenty of other companies. But since, I talk about these companies a lot, I thought that in this video, I'll focus on 4 other companies, 2 in the same sector, in the same industry, and then 2 other in different ones. Just because I'm talking about them today does not mean that it has to be a buy today. No, I keep saying the same thing. I rather buy when I see red days, when I see some fear in the market. So maybe put those on your watch list because yes, some of them might not be the cheapest stock out there. But I'll show you from a reverse DCF standpoint, I'll show you what I think is fair value. So before jumping into that, a couple of things. First of all, thank you to the 3 people that used my link for Koifin. Really appreciate it. Hopefully it serves you well in your investing journey. Second of all, thank you everyone for supporting this channel. We're now over 54,000 subscribers. Let's try and reach 60,000 by the end of the year. If you're new here, hit that subscribe button. It's free. You can always unsubscribe later. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so let's start with stock number 1. And it's, of course, an expensive one that has been expensive for forever, let's be honest. But it was a little bit cheaper, and it's a bit cheaper today than it was a couple of months ago, and that's Crowdstrike. Now, Crowdstrike, of course, had that event back in July, that outage, and so stock crashed 40% or so. But there was a recent conference called Falcon, just like their platform, Falcon, where they shared some crucial information. So when talking about their customers, the CEO said, I think this level of customer intimacy has been incredible. Obviously, some tough conversations, but most of my conversations end with, we love Crowdstrike. You've been a tremendous partner. How you've responded, what you've done for us over the last 2, 3, 4, 5, 10 years, however long they've been with us. And that really does set up an incredible opportunity on our path to $10 billion. 98% gross retention. We gave some stats out on the last earnings call. I covered that as well on the channel. Now, and here's the important part. Our pipeline generation has returned to pre-incident levels. That's very important because we were all waiting to see how big of the damage would be, right? Of course, there could still be lawsuits, but from a brand standpoint, let's say, from a business standpoint, it's great to hear that the pipeline generation has returned to pre-incident levels. So the machinery got started back up, and we really are a cybersecurity's innovator of choice and a single platform that can really drive consolidation. You know the categories we're in, we'll touch more on those. But the big areas that continue to get us excited is next-gen CM, just game-changing technology. By the way, they bought Humio for $400 million, I think back in 2021. That segment of the business is now generating $220 million in ARR and growing at 140% year over year. Not a bad business, right? Anyways, right now, Crowdstrike has a market cap of $70 billion, has a forward PE of 78.1 times. As you can see, it's not cheap at all. It's cheaper than its 5-year mean, right? On all of those metrics, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth. Yes, it is cheaper today than before. That doesn't mean that it is a cheap stock. No, it's still expensive. Now, year to date, it's up close to 12%. In the last 3 months, it's still down 26%. Now, with regards to Crowdstrike and what the analysts are expecting, with regards to EPS, up until 2034, of course, there are not that many analysts that are modeling until then. But the one number that we have here is basically a 10x increase EPS from January 2025 to January 2034, a 10x increase. So growth rate wise, I mean, this company is growing extremely quickly. From revenue standpoint, a 6.4x. Just so you know, you are paying a premium because this is one, best in class, and two, growing very, very fast. Now, of course, growth rates, especially when you look at revenue, that has come down, right? It has come down. I mean, back in Q3 2019, it was growing 96.9%. Now we're growing 33.1%. Yes, it's much lower, but revenue, total revenue has increased by a lot. We're now at $3.5 billion in the last 12 months compared to just $409 million back in Q3 2019. But we're still growing 33%. Free cash flow has increased quite nicely as well. If we look at gross profit margin and gross profit, I mean, gross profit has increased 831% since Q3 2019, and they now have a gross profit margin of around 75.3%. Now looking at revenue growth for the next 3 years, we've got 27.6% year-over-year growth next year, followed by 22.7% and followed by 22.3% year-over-year growth, reaching $5.84 billion here January 2027. As for free cash flow in the last 12 months, that sits at $1.167 billion. But if you look at January 25 compared to January 24 and the last 12 months, it's down a little bit. They will get impacted from what has happened from the outage, but not by much. And then, of course, the expectations is that, well, it is increasing again quite quickly, coming close to 30%. And so if we put all of these numbers here, free cash flow trailing 12 months, as we've just seen, is this number right here. I put a terminal growth rate a bit higher than usual, 3% here, and a discount rate of 10%. And so to justify today's price, the implied growth rate is 22%. Now, 22%, of course, is a big number. It's a big number. But as we've seen, it is expected to grow extremely quickly in the next 10 years. So yeah, maybe right now this is fair value. This is not undervalued, not overvalued. So maybe you would like to buy it on red days. Maybe you would like to buy it when it's down 5%, maybe even more. Who knows? But yeah, this is basically it. If you buy it today, this is what needs to happen. Now, of course, you can always put it on your watch list. But for the sake of this video, this is what I put here. Terminal growth rate 3%, discount rate 10%. And so the implied growth rate to justify today's price is 22% for the next 10 years. If you think it's too expensive or not, let me know down in the comment section below. Moving on to company number 2 is also in the security industry, more in the cloud security, and that's Qualys or Qualys. I talked about this company couple of months ago, and since then the stock has come down. This is a much smaller company and a cheaper one as well. It has a market cap of $4.79 billion. Year to date, it's down 33.7%. In the last 3 months, it's down 8.6%, and year over year, it's down 15%. Now here, forward PE is at 23.9 times, lower than the 5-year mean. EV to EBITDA, price to sales, price to free cash flow, all of those things are lower than the 5-year mean. And here price earnings to growth sits at 2.65, not the cheapest one out there, but I do think there is some value here, and I'll show you why. Now the big difference here compared to Crowdstrike, for example, is that, well, the growth rates are much, much lower, right? And it does seem like we're going through a down cycle right now, or at least the year-over-year comparisons are tougher right now than before. I mean, total revenue has grown closer to 10% or so. Since Q4 2018, total revenue has increased by 108% or so. Of course, not a high growth company like CrowdStrike, but a pretty strong one, a solid compounder, I would say. Free cash flow has increased by 148% on that same period, so a compound annual growth rate of 18%. I mean, that's pretty good. Then if you look at gross profit and gross profit margin, I mean, this is a very, very nice trend to see, right? Gross profit has grown very, very nice in the last couple of years, growing at a compound annual growth rate of 15.66% since Q4 2018, and we're now at a gross profit margin of 81.5%. Now here, revenue is expected to increase around 8% year over year in the next coming fiscal years. With regards to free cash flow, we are expected to dip a little bit before we go back up. So knowing that, what do analysts expect, or what have analysts said with regards to the latest earnings report? So we've got one comment here from Canaccord. Analyst has a price target of $160. That's down from $220, but kept his buy rating on the stock as the big picture is still intact. The company is executing well despite dealing with soft demand that has impacted the vulnerability management space. Additionally, the company should see an improvement in its growth rate as it gains more leverage from contributions from channel partners, and it ramps up its higher spending platform customers and introduces new growth driver. On the flip side, you've got an analyst from JP Morgan who said that execution headwinds are still an issue. Qualys reported second quarter 2024 revenue relatively in line with consensus expectations, with better profitability, stronger channel partnerships, and large customer growth. However, the net dollar retention rate deteriorated again this quarter. Guidance for full year revenue was narrowed, and billings growth declined 1.6% year over year, part due to lower attach rate. Upsell execution remains difficult for Qualys, even as management continues to expect to increase intensity of sales and marketing enablement, customer success, and productivity. Now, after reading those two comments, this is what more analysts are expecting in the coming years: EPS growth and revenue growth. I mean, it's around, let's say, 10% or so for the next couple of years with regards to EPS. With regards to revenue, it's probably a bit closer to 8%. So, knowing that, I've put here two scenarios. One with terminal growth rate of 3%, a discount rate of 10%, and so the implied growth rate to justify today's price is just 5.9%. Now, if you say, oh, terminal greater of 3% is a bit high for this company, especially if you look at the issues that they're having right now. Okay, fine. Then we have scenario number 2. That's where terminal growth rate sits at 2%. Discount rate is about the same, 10%. And so the implied growth rate to justify today's price is 7%. Now, we've just seen EPS around 10% growth is the expectations for a lot of analysts, but revenue is around 8%. So 7% is below both of those numbers. And yeah, maybe there are some issues. Maybe it might even get acquired. Who knows? But I mean, if you look at those two scenarios, in my opinion, it is considered cheap. Now, of course, some of you might say, oh, you have to put a higher discount rate because there's more risk. Maybe, but I think 10% for this company right now is quite okay. And so, yeah, 5.9% with a 3% terminal growth rate, or 7% with a 2% terminal growth rate. I think you can put this in fair value category, maybe even undervalued if you're very, very optimistic. What do you think? Moving into the next one, and that's a huge company, and a company that might be a monopoly, if that makes sense. So, Visa, that's the company. Justice Department sues Visa for monopolizing debit markets. Visa's exclusionary and anti-competitive conduct undermines choice and innovation in payments and imposes enormous cost on customers, merchants, and the American economy. The Justice Department filed a civil antitrust lawsuit against Visa for monopolization and other unlawful conduct in debit network markets in violation of Section 1 and 2 of the Sherman Act. We allege that Visa has unlawfully amassed the power to extract fees that far exceed what it could charge in a competitive market. Merchants and banks pass along those costs to customers either by raising prices or reducing quality of service. As a result, Visa's unlawful conduct affects not just the price of one thing, but the price of nearly everything. I guess MasterCard does not exist, right? I mean, this is a funny argument, very, very funny argument. Maybe they should sue the government because they're definitely not making our lives cheaper, right? I wonder when that will happen. Anyways, this is Visa right now. It has a market cap of $523.4 billion. Year to date, it's up 6.3%. Year over year, it's up 20.84% and has a dividend yield of 0.76%. Now, I've compared here Visa to MasterCard, and from a forward PE standpoint, MasterCard is more expensive at 32.3 times, Visa at 25.7, but from a price earnings to growth ratio, it's a bit more expensive, not by much, it's just over 2, whereas MasterCard is just under 2. Price to free cash flow, MasterCard is at 38.9 times, Visa 27.6 times. Of course, the stock did dip after that announcement. And from a price to sales standpoint, MasterCard 15.4 times and Visa 13.6 times. And if we're comparing and looking at total revenue and total free cash flow for Visa and MasterCard, Visa's total revenue since, well, for the last 10 years has increased by 174.9%. Free cash flow has increased by 185%. MasterCard's revenue has increased by 188.2%, and their free cash flow has increased by 217%. So growing a bit more than Visa. If we look at the expectations for Visa revenue growth in the next coming years, it's around 9 to 10% or so, 9.5 to 10%. As for free cash flow in the last 12 months, that sits at $18.96 billion. Now, with regards to Visa, of course, it had that great period, MasterCard as well, the pandemic, well, less cash. And by the way, since we're moving to a more cashless society, I think companies like Visa, MasterCard, I think you also have Discovery, maybe even American Express, they will be a huge beneficiary of that. But as you can see, revenue growth has decelerated a little bit, but that does not mean that this is not a solid company that increases its revenue year over year. I mean, if you look at gross profit, net income, it's an incredible company. It's an incredible company. Yes, it's Visa, it's MasterCard, it's maybe a duopoly. I wouldn't say it's a monopoly since there is Visa and there is MasterCard. So yeah, there is that. Now, if you look at the EPS and revenue estimates, how fast are they going to grow? EPS should be growing faster than revenue, as you can see right here, around 12-13% or so in the next coming years, whereas revenue still sits around 9 to 10%, as we've seen before. Now, knowing that, we've got these numbers. So I've put here the free cash flow trailing 12 months, $18.96 billion, a terminal growth rate of 3%, discount rate of 10%. You can even have a discount rate that is less than that because, well, the risk isn't that big with Visa, let's be honest. So the implied growth rate is 12%. 12% to justify today's price. Or you can have a terminal growth rate of 2% and then the implied growth rate is 13.2%. So it has to grow a little bit more than that. And since we've seen what the expectations are, EPS is around that number, revenue a bit less than that, but still you get a dividend, you get some share buybacks as well, so that helps in thinking about whether it's super expensive or not. So yeah, this is again one of those companies where I think, yeah, buy the dip has definitely not disappointed previous Visa shareholders. So yeah, this is what you get right now for Visa. Moving on to the next company, much cheaper. I think the cheapest of the four has a market cap of $8.57 billion and a forward PE of 10.9 times. Year to date, the stock is already up 54.4%. Year over year, it's up 70%. Now, compared to its 5-year mean, as you can see, it is lower forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth sits at 1.4. So definitely not the expensive stock. Now, what's the company I'm talking about? I'm talking about CROX. Yes, CROX. You might say beautiful shoes or ugly shoes. So these were the numbers from last quarter. CROX brand revenue increased 9.7% to $914 million. Then you've got the Hey Dude brand that has decreased by 17.5%. And that has been the issue with CROX, but it might be solved. It might be solved because the director of Dude is the one and only Sydney Sweeney. Now, if she does not manage to convince people to buy Hey Dude shoes, nobody will succeed. So, yeah, I guess the success of CROX relies on her good looks, I guess. Oh, and by the way, this isn't a joke. This isn't a joke. She's basically now the global spokesperson or ambassador for Hey Dude or something like that. Basically a new marketing thing. Okay, great. Couldn't have picked a better person, to be honest. Moving on here. What are the analysts expecting? EPS and revenue growth. So EPS is expected to grow, I would say on average 7% or so in the next coming years, whereas revenue closer to 5% or so. Now, if you look at CROX business free cash flow and revenue, you can see that thanks to the pandemic, we have seen a huge increase in revenue, right? Now you might say, that might just be a one-time thing, that might be a fad, and CROX might not be a thing anymore in the next couple of years. Okay, fine, that's a risk, and that's something you have to take into consideration 100%. Now, in the last 10 years, by the way, shares outstanding have come down by 28.2%. So that's a compound annual growth rate or decrease growth rate of 3.34%. Not bad, right? Now the issue, like I said, is the Hey Dude brand. The Hey Dude brand has not been performing well at all. As you can see here, it has been decreasing since Q4 of 2022, revenue and income from operations. Not great, but they should see some improvements. They should see some improvement, not in the next quarter, because the next quarter is there's still an issue, but in the future, they still think that that brand could be a big success. Now, despite its struggles, as you can clearly see, gross profit has exploded thanks to that huge pandemic boost. Gross profit margins are at 57% or so. There was a huge decline, but now that has recovered. And I mean, it's a pretty profitable company. It's a pretty profitable company, even if you think that, oh, it's a fad, it's going to go away. By the way, CROX has been around for quite a while. So yeah, of course, previously it wasn't growing as well or as much as right now or as in 2020, 2021. But I don't think it's going to disappear tomorrow. And so if you look at these numbers right here, free cash flow trailing 12 months, $876 million, two scenarios here. One with a terminal growth rate of 2%, but a discount rate of 11%. So a bit more than the others because I do think, yeah, that there is a risk. And the implied growth rate to justify today's price, 0%. 0%. I have to admit, I was pretty surprised when I saw this. Now, if we look at scenario number 2, that's with a decrease in free cash flow, because I'm looking a little bit forward. And if we saw forward, free cash flow is expected to be a bit less. So that's not trailing 12 months. That's looking into the next couple of quarters, $766 million. Here a terminal growth rate of 2% and also a discount rate of 11%. And so to justify today's price, the implied growth rate is just 1.9%. Just 1.9%. So even with these, let's say, more bearish assumptions, with risk calculated in it, increased risk, 1.9% or 0% implied growth rate. I think I can categorize this one as undervalued, right? Because we've seen it's expected to grow more than 0 and then 1.9%. It's not expected to grow 10, 20% or so, but 5% gives you a big difference with today's price. I can promise you that. So yeah, I think if you're looking for these types of bargains or something like that, CROX might be a company you want to dig a little bit deeper in. And so that's about it for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Thank you to all the members of the channel. Really appreciate your support, and I see you all in the next one. Bye-bye.